today is to take you through the economy, give you a quick update of where South Africa stands, and then hopefully take you through South Africa's challenges. What are those key challenges we have to resolve in the years ahead, decades ahead, depending on how quickly we can do it, that might set us on a higher growth path, where we not only have stronger growth, we have more inclusive growth, and we get in a society that ultimately starts to transform and starts to normalize given our history and where we come from. So that's what I'm going to try and do. And then I'm also going to give you Nedbank's view on how things are likely to play out. And we will cover all the essentials. We'll look at economic growth, we'll look at inflation, we'll look at the rand, we'll look at interest rates. That's going to be our aim. So given that we've got a bit of a tight time limit here, we're going to start looking at South Africa's economic performance and literally dive right into it. Now this shows you South Africa's GDP. You may have heard yesterday that the second quarter GDP numbers came out, if you read the newspaper, listened to the TV, and they were not too bad. We grew by 3.3%. Over the quarter though, that's the key point. Over the quarter compared to the first quarter, we grew by 3.3%. And the first quarter was dismally weak, where we contracted by 1.2%. If we look at the first half of this year, this economy has only grown by 0.3%. So we are less than 0.5% economy at the moment. And this is really the longer term tale. This graph shows you our GDP. There in red is the rand value of all goods and services produced in South Africa. And that green bar is the number they quote in the press. That's South Africa's GDP growth rate on a quarterly basis. This is the business cycle we're in at the moment. And if you look at this business cycle, you can very clearly see that over time, you've had a very choppy performances. Some quarters good, the next one we've lost momentum. But over time, South Africa has gotten weaker. And the last 2 years have been exceptionally weak. We grew only 1.6% in 2014, 1.3% in 2015. Then we shrunk by 1.2% in this first quarter, and we grew by 3.3% in the second quarter. But if we take the first half's experience and we contrast that to the first half of last year, we grew by only 0.3%. And we'll be lucky if we get that for the year as a whole. If we get 0.3 or 0.4% for 2016 as a whole, by the time we get to the 31st of December this year, we'd be quite lucky. It has been a tough time. Its underlying things are very, very weak. Whether you're in urban areas, whether you're in rural areas. And we need to understand, why has this economy lost this momentum? Why have we had this choppy performance? Or are the positive folks among us right? And is that second quarter number the beginning of a more sustainable recovery that we can look forward to? I'm going to tell you that I'm not quite convinced it is the beginning, and I'm going to tell you why as we proceed, okay? So let's have a look at what was behind that performance we've had so far. And we do it by breaking it down in sectors. How did we get to a point where last year we grew only 1.3%, and in the first half of this year we've only grown by 0.3%? So how did we get here? What we do now is we take GDP, that's that black line with a green dot on it, we index it to 100 in 2007. We take the value added of all your major industries, whether it be agriculture, whether it be banking, real estate, business services, whether it be your retailers, your wholesalers, and we index them to the same point in time. Now what this graph tells you is there's your average economy, the black line with the green dot in it. Which industries have outperformed the average economy and which industries have underperformed. So you can very clearly see where the weakness in South Africa is coming from, can't you? It's from those three lines at the bottom here. The worst performing industry in South Africa has been mining without a shadow of a doubt since 2007. Then there is manufacturing. It had got hit by the global financial crisis and the recession that followed, the world recession. It then stayed a bit of a recovery, but the last couple of years it's literally just been flatlining. Very choppy performance, one quarter up, the next down, but in all, it's standing still in terms of where its production levels are. And then the third one is power and water. Power, for obvious reasons, if you want to produce more power, you have to at some point finish a power station, which has proved tricky for South Africa. Water, it's been aggravated to some extent by infrastructure, but undoubtedly the last 2 to 3 years by the drought. Okay, so that's aggravated that picture. Nobody can control the drought. More recently, these three suffering industries have been joined by agriculture, as you can see there. That implosion in agricultural production, again, mainly a reflection of this El Nino-induced drought, which has been vicious, and its impact has been incredibly painful. I spoke to maize farmers in Modimolle, was it 2 weeks ago, and as I was driving there, it's just dirt. It's basically just dirt, and they, were feeding people in the area. They had a whole day there. Nedbank sponsored it, helped where they could help, but that gives you an extent of some areas really being an acute shock at this point. Others are still coping. If you go further into Mpumalanga, they are still doing quite well. The ones exporting nuts and so forth, your higher end, sort of higher value type of products, and then others are truly suffering. But overall, the impact of that drought, just on field crop production and so forth, has been devastating. It did in the second quarter, there were signs of it sort of dissipating, like maybe the worst is over, because it shrunk by over almost 7% in the first quarter, agricultural value added, and in the second quarter by only 0.8%. So maybe it's starting to fade, but of course it depends crucially on what happens between now and December and whether we actually get the rain or not. Nonetheless, this is not something anybody can really control, the weather. And up until that point, agriculture was a major positive contributor to this economy. Despite its volatility, it was still outperforming the average economy. The rest of the time, this economy has been carried by services. So what's kept the wheels on the bus turning in this economy has been services. However, the boost provided by services, all the range of services, have faded in recent years. It hasn't been strong enough to compensate from this persistent weakness coming from mining, manufacturing, and your utility sector. So that's how we got to where we are. Now let's look at the nitty-gritty behind it. Let's try and understand, why is mining underperformed? Why is manufacturing underperformed? What is happening in terms of power and water? What are the sort of broader structural challenges we are facing? And why is our growth rate faded from over 3.2% in 2011 all the way down to, well, at the moment, 0.3%. Okay, so how did we get here is the big question. And there are a couple of constraints on South Africa's economic growth performance, and I'm going to run you through them, and I'm going to give you our take on whether we think these will lift, whether they will start to fade, whether their impact will start to hurt us, or not, as we go along. But you will be in a position to make up your own mind, so you don't have to take my word for it. Now, one of the biggest challenges that hit South Africa has been the world economy. It's not been a hugely supportive place since the global financial crisis, but to be honest, since 2010, the world economy has been mending, and it has been healing, slowly and surely. And yes, in between, there have been all sorts of other crises, from the Greek debt crisis to the Eurozone sovereign debt crisis, to all sorts of other issues in terms of just fallouts and terrorist attacks and that derailing and causing nervousness. So we've had many little mini crises, but the global financial crisis was the big hit to the world economy. And to some extent, we are still dealing with that legacy because it has undermined the rate of growth in your advanced countries, which ultimately, in global terms, are your consumers, are your source of demand, effective demand in the world economy. So the world economy has been a painful place to be in. It hasn't been as supportive as it was prior to 2007, 2008. But from 2010, we have seen growth emerge from the world economy. It's been growing at a rate of around 3%. And yes, that is not fast enough. If you're talking about strong global growth, you want to see growth over 4%, 4.5, 5%. That in world terms is strong. So the world economy at the moment is chugging along, the wheels on the bus are turning, but it's just not turning fast enough. Now the International Monetary Fund, in its latest World Economic Outlook, moans about this, and they say that growth has simply been too slow for too long. So what's happening is that demand has just been too low, and as a result of that, the companies are not adequately investing in the different economies in the world economy to lift growth to a higher level. So your potential output, if this persists, will start to fall. So the world economy is in a critical juncture. And if you read any of the articles around the G20, you will see that it is an issue. Growth simply has been too moderate. But like I say, there has at least been growth since 2010. It has been improving. And really more recently, the momentum has been provided really by the United States, which is growing at a rate of over 2%. But most of your other advanced countries' growth has been very slow. And then more recently, the British decided they wanted nothing to do with the Europeans, and they broke, what was it, almost a 50-year-long relationship, and they chose to leave the EU. Now this creates another uncertainty for the world economy. Over time, that decision will shave off British growth, and it will shave off European growth. Once the UK finally starts divorce proceedings, which they've of course been very reluctant to do. It's like they want to enjoy for as long as they can the best of both worlds, and it doesn't work that way. The Europeans, on the other hand, is going to have to make a hard example of Europe, of the UK, because if they don't, the whole notion of the European Union is threatened. Because if there are no consequences to trade, to access to markets, if you leave, why stay? You understand? Why, if you're Spain, and if you're Portugal, and if you're Greece, if there are no consequence to leaving, why stay? Okay, Britain is a little bit different than those other countries because Britain kept its own currency, didn't it? And the other countries didn't. So there will be a bigger adjustment and bigger pain for them. Nonetheless, the assumption is that over the next little while, that in the next couple of years, that will start to hurt UK growth. You can see the IMF in its latest July forecast revising their growth rate for Britain down and for the Eurozone. For Britain more so than for the Eurozone. Okay, and then emerging markets, they've also been slowing, and in fact since 2012, emerging markets have had an exceptionally tough time. And that has everything to do with the loss of momentum in China. China has started to slow. China is the world's biggest consumer of commodities. So the biggest challenge for South Africa is not the US, it's not Brexit, it's not really what's happening in the Eurozone. It is the fact that Chinese growth is changing and it is slowing. China being the biggest consumer of commodities, all emerging markets being producers and exporters of commodities. So China is critical in our lives. It's hugely important in our lives. And Chinese growth has gone from over 10% to what it is likely to be this year of about 6.6% and 6.2%. Now you might say, well, that's still fantastic, but it's the impact it's had on the commodity markets that matter. All right, just to show you, since 2012, China's growth started to slow, and as that happened, commodity prices started to implode. All commodity prices, it didn't matter what you looked at, whether it be precious metals, industrial commodities, whatever the case may be, commodity prices started to slide. And the purpose of this graph is just to illustrate to you that South Africa has never escaped a commodity price downturn. What we have here in grey is South Africa's GDP growth rate. Those green areas are the areas the Reserve Bank classified as official economic downturns, okay? And this blue line is essentially the dollar commodity price, the Economist dollar commodity price index. Now you can see here, just to show you the relation, if commodity prices are rising, South Africa does well in terms of growth. The moment it falls, with a bit of a lag, we sink into recession. It rises, we bounce back. It falls, we sink into recession. That relationship holds. You can even go back to the 1960s. More recently, in 2012, commodity prices started to turn down. What's happened to our growth? It's slowly faded. Okay, that's essentially what's happened. Because over 61% of our exports are still in some way or the other related to commodities. 36% of our exports are for commodities. Gold, iron ore, coal, and platinum. 4 commodities. That's how exposed we are. And the problem is, of course, this cycle. And what has been the impact on that? Well, it's hurt our mining and manufacturing sector significantly. You look at their underperformance, it relates completely to the downturn in the global commodity price cycle. So the chances that South Africa will recover if global commodity prices don't do us a favor is very slim. Okay, that's the reality if you look at that relationship. So we need to know, where are we in this global commodity price cycle? Right, so this is where global commodity prices are. The good news is, from around, you asked me to find the good news. Here's the good news. Hold on to it, because it fades after this. So hold on to it. The good news is, from around June, July, we have seen an uptick in global commodity prices. It hasn't been a resounding bounce. It's more been like the slow drift higher, if you know what I mean. And then sometimes it slips a bit, and then, but every time your low is a little bit higher than your previous low, if you know what I mean. And that's pretty much where we are now. This little turn here, can you see that? That's since June, July. And if we look at the situation in the global economy, it does look like all of those enormous surpluses that existed back in 2012, and virtually any commodity you can think of, whether it be oil or iron ore or whatever, it has shrunk. There are still surpluses, but they have certainly been reduced quite significantly. So it's probably fair to say that the worst of the slide in commodity prices are behind us. So the question is, what's going to happen to these prices over the next year and a half, next 2-3 years? All right, is it going to be this sort of resounding bounce back we saw in 2009, 2010, or is it going to be a much slower upward drift that we saw between really 2002 and around 2006? We think it's going to resemble this period a lot more. It's going to be a very slow upward drift, partly because there are still surpluses in most commodities, but also because of the nature of what is happening in China. China is slowing, and as a result of that, you have a change composition. The Chinese want to make a transition. They want to go from an economy that used to be completely dominated by heavy industry, investment in infrastructure and commercial property, which of course consumes a lot of commodities, it's very commodity intensive, to one where services and consumption play a bigger role, which is a lot less commodity intensive. Not necessarily bad for anybody in the food business, but bad for your bulk commodities like our mining and our manufacturing. So they want to go to a less commodity intensive type of growth. And sometimes when you make that transition, something has to give. And the thing that's been giving is growth. And that's likely to continue as they try and make this transformation. And just to give you an idea what's happened to their imports. Their imports started to slow in 2012, more or less the exact same time that commodity prices turned down. Then it's been shrinking literally non-stop since 2014. That explains a lot of the pressure on our miners and our manufacturers. All of those exporters have struggled to sell their goods. There's less demand for their goods. Plus, they're getting a lower price for the goods. The combination of that has been severe strain. Your ability to ride that out, to a large extent, depends on what? If you can't determine your price, which the miners can't, manufacturers can't, they're price takers, then it depends on your control over cost. And in South Africa, most companies, to a large extent, have limited control over their cost, and we'll talk about it. Just to show you China's GDP growth, there you can see that slowdown coming through, all right? So definite slowdown there. So the worst of this, the commodity price slump, and that's been a big cause, not the main cause, but a major cause to the slowdown we've seen in GDP. The worst of it's probably behind us, but we're not going to go bouncing back like we did in late 2010, 2011. It's going to be more this sort of slow upward drift towards the end of this year. Probably only in the second half of 2017 are we going to start seeing commodity prices rise in a more meaningful and sustainable manner. In the meantime, we're sort of drifting about here at the bottom. But we are at least at the bottom. I know that sounds bad, but we are at least at the bottom. You need a cycle to turn. If it continues to fall, it does more harm. All right, so the worst of that is probably behind us, but it's not going to give us the kick we want. So our ability to function here at the bottom in commodity prices depends on our cost structures. And that is probably South Africa's biggest challenge. If you want to see the positive in this, which I promised I would give, is that at least we should theoretically have control over our cost structures, don't we? So that's something within our control. We don't control the global commodity prices, we don't control global demand, but we should at least be able to control our cost structures. So why has our mining and manufacturing industry struggled so much? Partly because we've seen a sharp escalation in production cost over the past 5 to 6 years, specifically from 2009. What has been the major contributors to that? Well, the biggest negative has been the relationship between the cost of labor and the productivity of labor. That gap has grown, okay? So wages have generally outpaced inflation in both the private and the public sector, and the gap between wage growth and productivity growth has grown. And that's essentially your cost, is the difference between wages and productivity. If you give somebody a 34% increase in their salary, but their productivity gained by 30%, your cost only increases by 4%. Very manageable indeed. So really it's these two that need to be together. What's contributed to that? Well, it's a complex equation in South Africa. It's probably our biggest puzzle to solve in the years to come. It will require political will. It will require perhaps that somebody might need to make themselves unpopular in the short term to get a long-term gain. A lot of it has to do with unions becoming more and more aggressive, and also really embarking on very destructive, almost self-destructive strike action. It also has to do with labor legislation, which has to a large extent tilted the power in the labor market towards the unions away from businesses. It's also got to do really to a large extent with our history, where a big portion of our population just didn't have the opportunity, just didn't have access to education, and now we're trying to catch up. And that catch-up carries a cost, doesn't it? And as a result, our productivity growth is not what it should be. So unfortunately, this is a very complex problem, but probably our most important challenge in the years ahead. But it has certainly deteriorated dramatically over the past 5 years, adding to the pain for miners and manufacturers, and actually the whole economy. But it's affected them more because they are price takers and primarily exporters. Okay, surging costs of utilities and basic economic services. What am I talking about here? We have lack of economic infrastructure, whether it be power, which is the one we all talk about, transportation. I was just sitting down at the lunch table listening to people talk about the state of roads, and the reason the roads look the way they do is because the trucks are on them all over the place. And really, those trucks are not cost efficient. They're moving small amounts of goods at a very high price. So inadequate and a wrong mix of transport infrastructure between road, rail and port infrastructure. According to the United Nations latest survey, our port tariffs are 300% above the global average. There's no good reason for it to be 300% above the global average. We are the most expensive in Africa. We have arguably the best absolute level of infrastructure, yet we are the most expensive in Africa. These sorts of questions need to be asked, and they need to be answered, and it needs to be rectified. Water infrastructure, telecommunication infrastructure, all of that really adding to the cost of production. Power is a very good example. We have inadequate power capacity, and at the same time, in order to build new power stations, which has cost us over 300 billion to date, okay, we have pushed up the cost of electricity tariffs in absolute terms by over 300% since 2007. So one element of your cost structure, it's broken through Earth's atmosphere, it's on its way to Mars, it's called power tariffs. It's competing with Elon Musk, it's going to be the first permanent resident there. But we don't care about that. In order for you to stay as competitive as you were prior to that, you have to be able to cut somewhere else, don't you? And we can't, because you don't control labor, really. What do you control in the labor equation? Only the amount of people you employ. Literally, that's it. So why don't we have employment growth? Because of the combination of these factors. If it was just one factor, it probably wouldn't have been that devastating. But it's the combination of all of them, accumulating, that has been hurting us. Okay, compliance cost and red tape. I'm not sure how much that applies to farmers, but it certainly does apply in the banking industry, in the retail industry, wherever you go. And in South Africa, it is uniquely complicated. Inefficient government services and corruption, very often, you know, literally the private sector has to undertake the cost to do things that is really government's job to do. Or you have to employ consultants to get problems sorted out. All of that pushes up your cost of production. So consequently, this has been a big negative. Now, like I say, the upside here is if you look at all of this, it should be within our ambit of control, not so. I mean, theoretically, we can control those things. And this is also, by the way, the basis of the National Development Plan. You must have heard of that, the NDP. The NDP is all about solving this problem. So it's on the right path, it's looking at the right issues. Of course, it's been broadly ignored, but this is really what we need to turn around. And this also explains why our economic performance has been so poor. Another factor that explains why our economic performance has been so poor is the fact that we just do not have enough power. Power is an absolutely critical ingredient to economic growth. Okay? At the moment, we're actually extracting efficiencies out of the power grid. We've got a GDP growth rate that cannot be warranted given the rise in electricity production. Okay, so we're actually doing pretty well under very difficult circumstances. Now, the IMF have done some calculations on this, and they've worked out, given South Africa's existing power capacity, okay, the best growth rate we can achieve under perfect circumstances is 1.5%. Okay? So what that means is, the moment you go over that level, you hit a constraint, Eskom can't cope, they have to introduce load shedding, and essentially what happens, everybody falls back. And if you look at those GDP numbers, that choppy performance, we want to grow faster. When we shoot over 3%, what happens the next quarter? Well, they phone up all the miners and manufacturers and say to them, long before they introduce load shedding, cut your consumption by 10%. So what happens? Growth slows the next quarter. So that's why we're kind of standing still. So until we finish a Medupi or a Kusile, we're not going to move forward. Now, I know many of you are saying, but things are going better we haven't had load shedding for quite some time. Yes, but we're virtually not growing, are we? Only 0.3% year on year in the first half of this year. That's the growth we've done. So demand for electricity is actually falling. It does allow Eskom the opportunity to go out there, do the maintenance they're supposed to do. But just to show you the improvement, there's the improvement they've been bragging about. That's their numbers, not ours. That's their numbers. Okay. So you've got to see these things in perspective. We still have an electricity constraint. We have to finish those power plants. If we even want to talk about growing faster, it's almost senseless being at war with each other when we don't finish a power plant, because no one is going to be any better off until we do so. All right. And the other problems, of course, hurting South Africa is increased policy uncertainty and political turmoil. Now, policy uncertainty has also been a feature of the past 5 to 6 years. It was not a feature of the ANC from 1994 to 2009. And you can read into that whatever you like. They were pretty clear on the route they were going. They managed this economy well. If those governments were to be criticized for something, it would be probably that they didn't do enough to infrastructure. They didn't plan infrastructure spending on time. They didn't start it on time. But other than that, they really managed the picture very well. But from 2009, a massive deterioration has occurred. And we have seen over the last couple of years, government keeps telling us, but the National Development Plan is the basis of our economic policy. The truth of the matter, though, is you can't find evidence of the National Development Plan anywhere, even if you look through a magnifying glass. That's the problem. And that's how foreign investors also perceive it. And if we look at the slew of legislation that has gone through, from your Land Holdings Bill, to your Expropriation Bill, to your Resources and Minerals Amendment Bill, to your... what happened there? I know it's a sad tale, but really, let's just keep it together. I won't be here much longer. All right, so all of these bills have a couple of things in common. What do? They reduce the rights of the private investor, whether it be an investor in a company, whether it be an owner of a company, whether it be the investor in land. They reduce the rights of the private investor, and they increase the right of government to intervene at its discretion. Okay? So unfortunately, that creates uncertainty. And in that uncertainty, if you are an investor, and for banks this is also a problem, what are your liability? You don't know. Because the rules of the game might change on you. And you might stand to lose billions, especially in mining, where it costs about 12 billion just to sink one shaft. Never mind develop a whole mine. You're only going to get your return in 10 to 12 years' time. So you need policy stability to even consider it. So that's why fixed investment activity has simply not been happening. To tell you, the capital expenditure in the first quarter of this year shrunk by 6.8%. That's vicious. In the second quarter, even though the economy grew by 3.3%, capital expenditure fell by another 4.8%. So companies are not investing. They are not taking the risk today. They are not expanding capacity. And really, it is that capital expenditure that determines how fast you will grow in the years to come, how many people you will employ, and what South Africa will look like in the years to come. And we are not doing that at the moment. And part of the reason we're not doing it is because we just don't know the lay of the land. We don't know if it's going to change on us. And it's because of this persistent uncertainty out there. And then, of course, more recently, something we haven't had for many years, which is political turmoil. All right? And what happened is, on the 9th of December 2015, our president fired Finance Minister Nene, which was an excellent finance minister, and we're starting to make some progress with stabilizing the budget, starting to make some progress with controlling wasteful spending, starting to reduce the deficit, and replaced him with a complete unknown. Everybody had to Google, who is this person? I even saw a joke that said white people were temporarily happy. That shall teach us, okay? Not to judge. And anyway, the outcome of that was huge disruption, foreign capital flight, the rand plunging to record lows. All of this happened literally a week after we were downgraded. Now, South Africa's sovereign risk rating, that is essentially, you've got three major rating agencies. You've got S&P, you've got Fitch, and you've got Moody's. These are the three major rating agencies. And they give every country a risk rating. And that risk rating really is just an indication. It's just an indication to global investors, to foreign investors, of what is the risk of putting your money in a certain country. So when you get downgraded, that means the risk of putting your money in South Africa has gone up. So all it means to the foreigner, he might still be willing to take that risk, but what it means to him is he's going to want a higher return, isn't he? And that's what it all comes down to. And we got downgraded. Then came the 9th of December, all of this uncertainty, and ultimately after the rand fell, after over 500 billion rand was wiped off the JSE, after bond yields surged to almost Brazil's level, which was already speculative or jump status, and the president retreated from his position and he put a steady and experienced hand, Minister Pravin Gordhan, back in to that position. Business and National Treasury got together and Labour got together and everybody made a concerted effort to try and stabilize the ship. They all went overseas, they saw the foreigners. I also went to New York in April. I also saw a bunch of foreigners and we tried to stabilize the ship. Everybody did that. However, of course, we did succeed because came July, when there was the next set of rating updates, South Africa was given a stay of execution, and we were trusted. And they said, no, we won't downgrade you any further. So that was successful. But of course, in between all of this, all sorts of things have been happening. You've got what appears to be an indirect threat to National Treasury, and that the Hawks investigation into Pravin Gordhan, there seemed to be no basis for that. That has got foreigners nervous. And you know what happened? On the 9th of December 2015, President Zuma basically broke the trust of investors. He did. They don't trust him anymore. Okay? And the only reason we didn't get downgraded in June, July, is because they trust Pravin Gordhan. Trust him to keep his word. Trust him to do what he said he would do. Okay? And that's what it's all about. Trust the Reserve Bank. Trust our court system. And consequently, what we see now is with this new investigation, with this new pressing of, well, not pressing of charges, but basically insisting that Mr. Gordhan has to come to give a warning statement and him deciding not to go, everything literally is up in the air again. Do I know how that will play out? No one knows how that will play out. No one. I don't even think the people who think they know how that will play out knows how it will play out. In the interim, you've had threats to the banking sector, banking regulation, which in South Africa is, by the way, superb. And I don't just say that because I'm from a bank. It's actually a cost on us. It's actually a cost for us. But it's kept us in the global financial system, and you can go ask Iran, you can ask Bolivia, you can ask Venezuela, what happens when you get kicked out of your global payment systems. So really, it's a cost for the banking sector to carry all of this legislation that resulted in the withdrawal of the closing of the accounts of the Guptas, but it is good legislation. At the moment, it's run and executed by the Reserve Bank, which are brilliant at doing that. It's globally acknowledged that they're good at it. Now we're fiddling with things that aren't broken. What should we be fiddling with? The things that are broken. Okay. So unfortunately, all of this had created a tremendous amount of political turmoil. And just as it hurts foreign investors, it also hurts South Africans. All the citizens in South Africa are affected about it. Whether you're rich or poor, no matter who you are, most people are worried about where are we heading. Okay, and all of these things eventually start to impact on households as well. They start to feel that strain. And how does it happen? The first thing that happens is when companies are taking strain, like they are in mining and manufacturing, what's the first thing they do? They cut back on their capital expenditure, okay, so they do less capex, okay. That has a ripple effect to all those industries that supply products into capital expenditure projects all over the place. And so their conditions are weaker. They have to rethink and they have to consider rationalization. And the second thing they do after they've cut capex and it's still not going away and things have not improved is they retrench workers. And the moment they retrench workers, you now have this cycle continuing into the rest of the economy. Now there are less people earning an income, less people with the ability to spend. And that's kind of where we find ourselves today. Okay, so households are feeling the pinch. Unemployment in South Africa, which is structurally high, okay, it is structurally high. Our unemployment has just been unacceptably high for an exceptionally long period of time. But recently it spiked back up to over 26% on the narrow definition. If you add to this over 2 million people that are discouraged workers, you get to an unemployment rate of about 34-35%, among the highest in the world. So this economy is failing the bulk of South Africans. There's no doubt about it. It is failing as it stands. So it really does need some reconsideration. But anyway, that spike in unemployment certainly meant there were less people earning an income. We saw disposable income come under pressure. This is growth in consumer spending and disposable income. That's the pattern. You can see how we slowly lost momentum. 2013-14, around all of those long extended strikes in the automotive industry and the platinum mining industry hit income very badly. Income recovered for a little bit, and now it's losing momentum again. It grew by less than 0.1% in the first quarter, probably grew by less than 0.5% in the second quarter. So consumer spending really taking strain as a result of those developments. Less capital expenditure, less employment, that starts to now have a knock-on effect on household income. Okay, household income taking strain, that's one factor affecting the consumer. The next one is that most consumers are still quite indebted. Okay, and that also hurts. This is our total household debt burden in South Africa, that green bar. That shows you South Africa's household debt burden as a percentage of our income, of household income. And it's at around 76-77% of our income. Now, that's high, okay? But what matters is our ability to service that debt. And that's a function of what? Interest rates, not so. Okay? The interest rate determines how much it's going to cost you on a monthly basis to service that debt. And unfortunately, the bad news there, and that's this black line here, which is debt service cost as a percentage of your income, it is approaching this 10%. Now, the Reserve Bank, when they look at the sustainability of banks, work that in as a key stress level. And the banking industry, when we want to see what is our risk of bad debt, we know at 10%, whether you go back to the 1960s, this is the level where South African households hit a constraint. And they have no more option but to cut back on their spending and repay their debt, or they default. And the banks have to absorb that pain. So we are approaching 10%, you can see very rapidly, and the reason for that is that interest rates have gone up by 2% over the past 2 years. Now, 2% over 2 years in the South African context is nothing. It's mild stuff. We're made of tougher things. So why is it hurting us that much this time round? The reason it's hurting us is because of our overall debt burdens is way higher than it used to be. So you don't need a big increase in interest rates to suddenly start to affect your pocket, because your debt is that much higher. And that's where we find ourselves now. So the question is, what will happen to interest rates going forward? Now, what will happen to interest rates depends essentially on what happens to two things: inflation and financial stability. Okay? The Reserve Bank determines what happens to the official interest rate, and they will determine the interest rate based on where they think inflation will be over the next 2 to 3 years, and their target is to keep inflation between 3 to 6%. All right, that's their target. But that is their explicit target. At the same time, they have a mandate to maintain financial stability. Now, if we say maintain financial stability, what do we actually mean? Keep liquidity in the system. Keep liquidity in the banking system. And what is that liquidity? It basically just means that you have to fund your debt. Now, what is South Africa as a collective's debt? Well, it's government debt, because government runs a fiscal deficit. And then it's the economy as a whole's debt, which is reflected in our current account deficit, which is our trade deficit plus our services deficit. Okay? So, financial stability means that South Africa has to find a way to continue to finance its fiscal deficit, of which 40% is financed by foreigners, and its current account deficit, which is running at about just over 3%, which is a high level by global standards. All right? Now, what does it mean when you've got a current account deficit? It means that your imports exceed your exports. So you don't earn enough dollars and euros for your own exports to stock your shops with imports. So foreigners have to willingly give you the dollars and the euros to go out there, buy your goods, and get your imports and have your stocks nicely shopped. And also for government. Foreigners have to willingly invest in government debt so that they can finance that deficit. All right? So what this means, in net terms, South Africa is short of foreign currency. That's what it means. In net terms, we are dependent on foreign capital inflows. And it's the Reserve Bank's job to keep that money coming in. And that's where the sovereign risk ratings become critical. Okay? Because basically, we need foreigners to willingly give us dollars and euros to invest it. And they're not going to do it because they feel sorry for us. Never are they going to do it because they feel sorry for us. They're only going to do it if the return makes sense given the risk. So if your risk rating is being downgraded, that means the risk has gone up. That means you want a higher return. Now, if you're China and some segments are growing 10% and others are contracting, and people invest in that segment that's growing 10%, it's not a problem. Okay, it's not a problem. They're getting a massive return if they're investing in the right sector. In South Africa, there's no growth. Okay, the JSE at best looks toppish. Okay, so that's not offering you any return for the risk you're taking. Cash rates are quite low. So what's left? Basically the interest rate. You have to push up the interest rate to compensate for the risk. So the Reserve Bank will always be aware of that. At the same time, that capital inflow determines the value of the rand, doesn't it? Where the rand trades. And the rand is a key ingredient into inflation. So it all sorts of fit together for the Reserve Bank. They have to watch the rand to see where inflation's going, and that determines what they do with interest rates today. Okay, so let's look at inflation. The biggest source of inflation has been food inflation at the moment. That's all drought related. Now, if we get a good summer rain season and we get a good summer crop, then all of this will start to fall. It won't fall first thing 2017 because there's a lag. It will probably fall second half of 2017 into 2018. The Reserve Bank is not going to overreact because food inflation is at 11.5%. It's devastating enough for South Africans. I mean, basically, you know, you've got food inflation increasing at over double-digit levels. People are a lot poorer than they were. So that's not going to cause them to overreact. Oil prices, commodity prices, as I said before, there's good and bad in the commodity price cycle for South Africa. The good is that oil prices fall. We are net importers of oil. The bad is that other commodity prices also fall. We are net exporters of other commodities. So just as I said before, the worst of the slide and commodity prices are over. Well, if it applies for other commodity prices, it applies for oil as well. So oil, there's the rand oil price on a daily basis. And you can see it's been floating around at the bottom. We are in the bottom. Okay? And as I say, we believe it's going to start drifting up. So it's going to become a source of inflation. 2017, 2018. Not right now necessarily, but going forward. So the Reserve Bank will be a bit worried about this. They won't worry about this too much, not until it doesn't rain, okay, for months and months and months. They will worry about this a little bit going into 2017, 2018, but their biggest headache is this thing called the rand. And here's the problem. They've both set the interest rate, and its biggest driver is the rand. Okay? Even oil and food. If you've got a drought, what makes food prices rise even more? A weaker rand, because you have to import it. Oil, same thing. As global oil prices are ticking up, what makes it even worse? If your rand is weakening, that exaggerates the effect even further. So the rand is the key in almost all of this, and the rand is utterly unpredictable. The World Bank the other day made a statement that they will no longer try and predict the South African rand. They have proved mathematically that it's impossible to do. Okay? And yet, despite that, I shall now have to give you a number. That's how unkind they are to us. But we'll try our best. So here's the rand, okay? You all know they're going up to in 2015, what happened to the poor rand. All of this related to Nenegate, to all of the confusion around that, to incredible suspicion, as to the motives of South Africa's political leadership. And then all the hard work that went in to try and keep our sovereign risk rating unchanged, a relatively good budget, the promise that they will cut the deficit, showing some progress in some areas, and essentially the rand pulled back. Then we also had better numbers in the second quarter, that 3.3% growth rate. And more recently, once we've seen that essentially the Hawks are now pursuing this case against Pravin Gordhan even further. It has really been viewed as an attack against National Treasury. It has been viewed, generally speaking, as being sinister in the markets, rightly or wrongly. That's how they take it. And let me tell you now, if Pravin Gordhan is to be fired, which he can, it is the president's right to do whatever he wants to as far as that's concerned. The markets will not accept it. They will not. That position is not even negotiable. And then you can be certain the rand will fall. So that's how uncertain the environment is. Now the Reserve Bank has to make a decision. Now what drives the rand? Domestic factors and global factors. Since 2012, the biggest drivers of the rand has been global factors. Okay, just to show you, if you don't believe me, I'm going to skip through that. I'm going to get you here. This shows you global capital flows into developed markets and into emerging markets in red there, okay? So this is where foreign funds are going. It's going into developed markets, it's going to emerging markets. And you can see, since 2012, when China started slowing and commodity prices started falling, what's happened is investors have moved out of emerging markets on average, and they've shifted into developed countries. Can you see that? Your risk-free countries, your low-risk countries, your US government bonds, and your US equities, and your UK government bonds, and German government bonds, and Swiss bonds. That's where they've gone. And it's been partly because emerging market growth disappointed as China slowed, as the commodity prices slumped, but also partly because the US, since 2012, have been promising the world they're going to hike interest rates. They're going to normalize their monetary policy. And remember, they cut their interest rates to near zero during the global financial crisis to stimulate the economy. They also printed money. They stopped printing money in 2012, but they have still not moved on interest rates. So what you've had is these incredibly vicious cycles. So even within this bigger move, there's been smaller moves. Can you see that? Now they sell out of emerging markets, there they come piling back in. Then they sell out, then they come piling back in. Then they sell out, then they come piling back in. Why? Every time you're heading into a Federal Reserve meeting, everybody's saying, oh, they're going to rise interest rates, aren't they? If they are, I want to be in there before they do it. So they all sell out of emerging markets, they climb into advanced countries, and they wait for that higher interest rate. What has happened, in fact, since 2012, is that the US have only hiked once. And that is in December 2015, where they took their interest rate from a whopping 0.25% to a fantastic, stunning 0.5%. And ever since then, they haven't. So you can see what happens to the foreign investor. They go and sit in these low-risk assets, and they're waiting, and they're waiting. And the returns aren't coming. Their customers are getting irritated with them because they're giving them 1, 2, 1.5% returns on their investments. So the temptation grows, and it grows, and it grows, and it grows. And eventually they go, okay, that's it. I'm going to South Africa. I'm going to give myself a cool 9, 10%. And if anybody does anything stupid, if President Zuma suddenly and abruptly, essentially fires the finance minister, or Mr. Malema says something frightening, then all I do is I sell and I leave. Why? Because at least it's a liquid market, it's a deep market. I will be able to sell. And that is what we've seen. And what's been happening here is this frustration with the US not hiking rates. And the last little while, since around February, we've seen foreigners return to our markets and piling back in. It's not because we've done anything necessarily fantastic. It's just because they're irritated with the return they're getting in low-risk countries. Do you understand what I mean? And the gap between emerging markets and advanced countries, that gap, that difference, is essentially the risk premium attached to emerging markets. And I show it to you in this green line. This green line represents the difference between these two. There's the risk premium for emerging markets. Now if you take that risk premium for all emerging markets and you put it against the rand, look at that. It's an exact match. It's an exact match. So really the rand has been driven by global factors more than anything else until we get to December 2015. And then we did the world a favor and we introduced a whole bunch of South African unique risk to the equation. Okay. So from the Reserve Bank's perspective, they're going to try and have to determine what will happen to US interest rates because that will drive these global capital flows. As far as the US is concerned, I think they will hike in December and they'll probably continue to hike during the first half of 2017. Those hikes will be very slow. Because if there's one thing you can I can guarantee you about the US Federal Reserve, they do not believe suffering makes you a better person in the long run. Don't believe it. They believe only in the pursuit of happiness. And if happiness is even remotely compromised, they will not hike. Okay, so essentially it's going to be a slow increase. So that might work in our favor, and that it creates, demand for currencies like the rand because it's moving so slowly on the other side in terms of interest rates. However, it will only work in our favor if we don't mess it up, if we don't score own goals. And this is where we get to the hugely unpredictable. What will happen in the standoff between the Hawks and a National Treasury on one hand and Finance Minister Gordon? What will happen as far as South African Airways is concerned, a National Treasury? What will happen as far as Eskom and Transnet and Prasa is concerned, a National Treasury? So there's all of these unknowns. What will happen with the repayment of the money the Constitutional Court asked Mr. Zuma to do, or ordered Mr. Zuma to do? What will happen to that 783 fraud charges against Mr. Zuma? According to the High Court, they have to be re-examined. They have to be reinstituted. Will that occur or won't that? In the interim, in this vacuum, what sort of other uncertainty and instability will emerge? All of this will ultimately determine our fate. Anything, however, that involves hurting National Treasury, removing Finance Minister Gordon. Now, you often hear the politicians say, this whole country does not just depend on Finance Minister Gordon. If they remove him, let me tell you, the market's position is clear. The rand will fall. South Africa will get downgraded. We will live on. I mean, it's not like the oxygen gets sucked out of the air, out of the environment, but we will feel the pain. Okay, so it will hurt. No matter what the politicians say, it will. If they hurt the Reserve Bank, even worse. That's even worse. Then you're going Venezuela, Bolivia, Zimbabwe. You're going that sort of route. And if they undermine the integrity of the banking sector, if we can keep that, our courts, our treasury, our banks, and our Reserve Bank intact, South Africa can survive this. And politics is always volatile. Look at Donald Trump. He is such a person. He says the things he says. So, they're implausible people all over the place. So, then I think we'll survive. So the big question between now and December, in the last week of November, Moody's brings out its sovereign risk rating upgrade. In the first week of December, Fitch and S&P do. The big question is whether they will downgrade us or not. And that will depend on what happens on the political front, I think, more than anything else. It will be the bigger factor than the US interest rate hikes, because I think everybody is starting to accept that's going to be a slow crawl. All right? So US interest rate hikes is not going to be the enormous driver. It's going to be what we do. Our biggest fear here is Fitch and S&P. If Fitch and S&P downgrade us because they've got us one notch about what is considered a speculative or sub-investment grade status, that means we now fall into speculative or sub-investment grade if they downgrade us. That's your junk status. When I was in America speaking to a group of people in New York, among them was a Brazilian. And you'll remember they got downgraded to junk status. And he said to me that junk status is effectively worse than divorce. You lose half the value of your assets and you're still stuck with your wife. So he suggested that we do everything we can possibly do to avoid it. Okay, so it's an unknown. So what I'm trying to say is the Reserve Bank is going to have to err on the side of caution. They can't cut interest rates even though this economy is weak. They have to keep attracting foreign currency into this economy. If they don't, the rand comes under pressure. That means higher inflation. That means they'll have to overreact on interest rates somewhere down the road. The one good thing about our Reserve Bank is it's always been run by solid individuals. Our current governor is incredibly competent. He was very competent at National Treasury. He is very competent as the governor of the Reserve Bank. He's a very calm head as well. He's not going to overreact. So that's the good news. What do we think will happen in December? Nedbank's view is one rating agency will downgrade us. We see them though, they come to see us. So we have a sense of what they're thinking. And that will be S&P. S&P is very negative of South Africa. They simply do not trust us. And the bit that worries them the most really is around this, political interference. That concerns them the most. So what can prevent a sovereign risk downgrade, no matter, even if you've got all of this political turmoil, is if Mr. Gordon can stick to this budget plan. If he gets to that, it's going to be very difficult for them to downgrade us. Even if all sorts of horrible things happen around us. Because you can't downgrade a country that has a deficit below 3% of GDP to junk status. That's absurd. Okay? So that's the one favor he can still do to us before he gets off, before something unpredictable happens and he has to leave his post. So that comes in October. So a lot of uncertainty is still ahead of us. So what do we think the Reserve Bank will do? They will probably hike in January. Okay? And they'll probably hike at 25 basis points. Depending on what happens between now and then, if Mr. Gordon gets charged, if he gets arrested, if the rand plunges, they might have to hike again. But for now, we are assuming that this doesn't happen. We're assuming we get only one rating agency that downgrades us to junk, and that's S&P, and the others hold us. And under that environment, the Reserve Bank will probably only act once. That's another 25 basis points. That takes your prime to 11%, and then it starts to come down again as inflation starts to moderate. But even in this environment, this year is going to be a tough year for consumers. Consumer spending, we anticipate, will only grow 0.7% this year. Next year, provided nothing disastrous happens, this economy starts to pick up a little bit, going to 1%, 1.5%. Remember, if we want to grow by more than 1.5%, we have to finish a power station on an annual basis. So if by 2018 we've got a few more units available from Medupi and Kusile, then we can start to talk about 2%, 2.5%. But it's going to be a slow, gradual route for South Africa. And in the process, we can still shoot ourselves in the foot. We can do that. Okay? Or we can do ourselves a huge favor, get some clarity, get more competition, open up our markets, get a bit of transparency, get rid of some of those legislation. They haven't been signed yet. Just make a statement you're not going to sign it. It's not good policy, leave it. All of that will create certainty. So we can either help ourselves or we can hurt ourselves. But this is the sort of weighted average of that risk, and that's how we see it playing out. Over this process, interest rates go up in the short term, and in the long run, they start to come down again. And over this period, the rand actually is under persistent pressure. The thing that helps the rand is essentially the fact that bond yields in most of your low-risk countries are negative. You are paying them to finance their debt if you're investing in the UK, and German bonds and Swiss bonds. You understand what I'm saying? So that does create an incentive to take some risk. That does create an incentive to take some risk. And consequently, we think these foreigners will be knocking on our doors, but it's going to be in and out, in and out, in and out, that sort of situation. We've had it for a while, and it will probably persist in the years to come. And that's my tale. I'm done.